Good morning. It's Jeffrey Christian of CPM Group here. It's 10 o'clock here in New York. Thank you for joining us today. We will be reviewing the results and conclusions of our 2025 Platinum Group Metals Yearbook today. I'll make some opening comments and then pass the screen and baton to Rohit Savant, our Director of Precious Metals Research and the primary author of most of our precious metals research these days. He'll run through our supply demand views for gold, platinum, palladium, rhodium. I'll say a few words perhaps at the end about the other three minor PGMs, ruthenium, iridium, osmium, and then we'll open it up for questions and we'll take questions. We have a lot of questions right now that have been sent in ahead of time. You may use the question area on the webinar place to type in more questions. A lot of the questions were gold and silver. We're focusing on Platinum Group Metals today. We have more Platinum Group Metals questions than we could possibly address in this seminar, but we'll try to touch on the top ones that haven't been covered in the presentation. Carla Sanchez, one of our partners here at CPM Group, will manage the questions for us during that period of time. I want to start by thanking our sponsors and our Chinese partners. CPM Group has been producing these reports for 39 years as Platinum surveys and yearbooks, annual, and then first quarterly and then annual things. But they actually started in 1981 when I was running the J. Aaron research department, and we added Platinum Group Metals annual review and outlook to the gold and silver reports that Aaron had done through the 70s before I arrived in 1980. So these things have been around since 1981. The data goes back to 76 for much of it because as we were developing the data starting in 1979, we were able to take it back about 3 years. We have sponsors and Chinese partners that help underwrite the research that goes into this. CPM Group is a research and consulting company. Our product is research and analysis. So we need to sell research and analysis to have the budget to do our research and analysis. We don't rely on donations to market and promote things, and we don't sell precious metals. We sell precious metals research and consulting. So we have sponsors that help underwrite the research project. Semblon is a research company that is working on liquid organic hydrogen carriers. They have identified molecules that are able to carry sufficiently large amounts of hydrogen so that they can be used in motive transportation as well as stationary sites. Stillwater Critical Minerals has some very interesting PGM properties in the United States and in Canada that they are exploring and hoping to move toward development. Kitco Metals, I think everyone knows as one of the premier refineries in Canada, as well as the owner of Kitco Media. Correlin Economics Reports does a lot of work on podcasts focusing on precious metals and mining and other metals. Institute of Scrap Recycling Industries is the U.S. Industry Association on scrap recycling. We have worked with them since the 70s. They include people who recover precious metals from scrap. Sabin Metals Corp is a refinery that is one of the larger refineries of Platinum Group Metals from spent industrial products as well as other sources. And Modex Precious Metals is one of the premier precious metals wholesaler and retailers of precious metals for investment purposes. Our platinum and gold yearbooks are translated and distributed within China by the China Gold Association China National Gold Corp, and Beijing Yicheng Technology. This is a relationship that began, I think, probably around 2014, so maybe earlier. It's been going on for a long period of time, and we're very proud and happy to have that relationship. In addition to the partners and sponsors, we have media partners who will help distribute our reports. Glacier Publishing, which produces the Northern Miner, Kitco Media, Metals Daily, Minera Andina in Peru, Proactive Investors, and Prospector News. And Prospector News, I have to give a special shout out because Michael Fox does an excellent job in promoting CPM Group and helping people realize when we have reports come out. Perhaps he is a better marketer than CPM Group is itself. We also have distributors that are not media partners, but that are companies that are involved in the precious metals industry. CGS Events, Gold Blocks, Gold Silver Central PE, companies in Southeast Asia, in Singapore that help us work with distributing precious metals research and consulting services. Intro Act, which distributes our research to institutional investors. Prospector News again, Southeast Asia Consulting, the David Lynn Report, and Fortel Private Limited. And we appreciate the relationships that we have with these companies. Many of these relationships extend back at least to the inception of CPM Group in 1986, 39 years ago. And some of them extend back even before that to our days at J. Aron and Goldman Sachs before we spun out of those companies in 86 to set up an independent research and consulting company. I want to talk a little bit about the global economic outlook. And it's a very difficult time. It's a very complicated time. And it's a complicated time economically, politically, and in terms of the financial markets for a variety of reasons. Globally, and in terms of the United States and many other countries, we've never been in the financial situation that we're in today. And we've never been in the economic situation that we're in today. After World War II, there was an international economic regime that was established by the victors, and it has basically been in place until now. That is now up for revision. People have talked about revising it since the 1950s, but there are changes going on. In addition to that, you have societal and political changes which are reducing international cooperation and reducing information. And you have this additional societal issue, which is a new system for information distribution. More people now gather their news, if you will want to call it news and information and opinions from internet-based entities rather than established journalistic outlets. As a result, you have had an explosion of bad information. Some of the information, it spreads throughout the whole place. But the thing I want to focus on right now is we have right now a situation with the U.S. government introducing tariffs, and they're doing it in a very sporadic, erratic fashion. So it's not quite clear, even to the economists who are trying to keep track of it within the government, whose and what tariffs are being applied to right now, how many tariffs have been threatened, how many tariffs have actually been imposed, how many tariffs were imposed, but then suspended until some other time, some of them till August 1st, some of them till September, some of them indefinitely. So it's not very clear how extensive the tariffs have been. In addition to that, the U.S. government has made a number of other changes, including rounding up illegal immigrants who are in the United States illegally, and deporting them. Those are having economic issues. And right now, last week, the Farming Association has petitioned the U.S. government to please stop having farm field raids by ICE to arrest people who are here on an undocumented basis. Because quite frankly, the crops are rotting in the field because people are not showing up. Meat packing companies in Omaha and other places in Nebraska and the High Plains are having problems. They have had 80% of their staff either arrested or refusing to come to work because they're afraid that ICE will raid their plant again. And as a result, you're having supply chain issues with agricultural products, meats, and other issues. So we're into a complicated area. Then you have the new big, beautiful budget bill, which was passed this month by the government. And it has severe reductions in workforce, not only in the US government, but also at research institutions across the country and private corporations that have had government funding supporting them for decades. So you have severe issues. But if you look at the big, beautiful bill, like the tariffs, many of the most stringent reductions in funding are postponed until after the 2026 congressional election. So they passed it, but they don't want it to be executed until they've been reelected. Because they realize that if they did this today, there would be a lot of people who would not vote Republican in 2026. So that is for next year. But the tariffs are right now. And you hear constantly people saying, well, the tariffs haven't affected the US economy that negatively yet. That's because most of the tariffs that have been announced or threatened haven't actually come into effect, or they have come into effect, but almost immediately are given exceptions for critical issues. So the fact that the US economy only contracted by 0.5% in the first quarter, and we're waiting, tomorrow we'll hear the first flash estimate for the second quarter. The fact that the US economy has not been thrown into a recession and has not experienced sharply higher inflation, only modestly higher inflation, over the last 3 months or so, since the administration started putting these policies in place, is meaningless. It's meaningless. These policies have not really come into full effect yet. They will in the second half of this year and in 2026, and in some cases in 2027. So the negative economic consequences that many economists, including CPM Group, expect from these government policies in the United States, and they're being reflected to some extent in many other countries, will not be seen in current data or in the GDP or the CPI or the PCE that will be released this week. They will only be felt as time progresses over the second half of this year, 2026, 2027. CPM Group has been expecting, even before the Trump administration was in power, CPM Group has been projecting a recession sometime between 2024 and 2026. We've been projecting that since at least 2021. And I think that even before the COVID lockdown in 2020, we were saying that it was probably a recession was inevitable, but was probably delayed several years away. And in the COVID lockdown and the subsequent recovery have interrupted that. But you can see here, there were trends of slower production, slower economic activity in the developed world and on a global basis that really started to appear during the Great Recession and the global financial crisis, 2007 to 2011. And they were interrupted by COVID and the post-COVID recovery, but our projections are that they continue and accelerate after 2024. So we're still looking for a recession, perhaps, probably, most likely, a pretty severe one, similar to the Great Recession, but not quite as deep. Yeah, far more serious than the recessions that we saw in 1981, in 1980, 1981, 82, 1991, and 2001. We're looking for for a recession at some point on the next 2 years on a global basis. And then in the economic recovery after that recession, we're looking for slower growth. Growth slower on a global basis than has been the case since the 1980s. That reflects anti-globalization, a breakdown in international trade. Tariffs are in there, but they are actually just they are a symptom of the disease that is going to reduce global economic activity. That's our long-term economic environment. That is very important for Platinum Group Metals, Platinum, Palladium, Rhodium. Major uses of all three, the major use of all three is autocatalysts. Those are the issues that these markets are facing going forward. With that in mind, I'm going to throw the microphone over to Rohit and let him deal with what we think is happening last year, what we think is going to be happening this year, and just have to make sure that I'm doing this the proper way. Let him talk about the Platinum Group Metals last year and this year, and where we see things going. Rohit, take it away.
Thank you, Jeff. So let's start here with platinum. You had platinum prices last year moving mostly sideways in a range that they've been in really since 2022. Prices have remained in that range during the first 5 months of this year until late May, when prices shot up strongly and were actually back up to levels that we saw last in 2014. So the sharp gains that we've seen since late May into June and July, there were a few factors that came together that helped to push these prices up that strongly. So first was a market report that suggested that the platinum market was in a deficit. Then you had data that showed strong gains in Chinese platinum imports. And you had some dislocations in the market caused by tariff-related fears. So all of these things came together around the same time, helping to push platinum prices higher. And they've managed to sustain themselves around that $1,400 level since then. So CPM Group's analysis and conclusions after doing this report is that the platinum market is not in a deficit. This surplus deficit is calculated as a difference between newly refined platinum supply and fabrication demand, and it does not include investment demand, which, if included incorrectly, would result in a market deficit. What we have been seeing and expect to continue seeing in 2025 is a sharp reduction in surpluses. What we have been seeing is a decline in both newly refined supply as well as fabrication demand. And so far, the weakness in fabrication demand has slightly outpaced the decline in supply, which is what is keeping these markets in a surplus. That said, despite the sharp decline in platinum market surpluses, the platinum price has kind of been moving sideways and not really performed as strongly until recently. So one of the primary reasons for this somewhat weak platinum price performance in recent years, despite this sharp decline in platinum market surpluses, is the massive buildup in above-ground inventories. As can be seen, much of these inventories are held by investors, and it's critical to see what happens to these inventories that these investors are holding with prices hovering around this $1,400 level. So $1,400 was a pretty important support level when prices were coming off their record highs in 2011, 12, 13. Prices have stayed below those levels, below 1,400, for a little over a decade at this point. So it is expected that at least some of those longer term investors are likely to liquidate their positions at current price levels. But if investor sentiment towards platinum remains positive, there is a possibility that you start seeing fresh long buying at current price levels. So while there are some positives for platinum fabrication demand and platinum supply as well, there are a number of headwinds as well. So the investors are likely to be hesitant to build fresh long positions now unless there's a clear sign of supply side issues or a sharp increase on the fabrication demand side. So what you're looking at here is the Chinese platinum imports since the beginning of last year. And as I mentioned before, this was one of the factors that played an important role in driving platinum prices higher at the end of May. So at the end of May, you had data released for April, and as this chart shows, there was a pretty large jump in platinum imports into China during April, which continued into May. But these gains in April, May, and even June to some extent need to be put into perspective. For one, you had much lower imports into China, platinum imports into China between October of last year and February of this year. So a lot of the buying that was done in April and May was more likely to be restocking in response to that weak import demand between October 2024 and February 2025. And also, there was an increase in imports because back in April and for most of May, platinum prices were still moving in that somewhat sideways fashion that they've been in since 2022. In June, you did continue to see a healthy amount of imports of platinum into China, but there was a 6% month-on-month decline, which can be attributed to that sharp gain that we saw in platinum prices in June and July. If you look at it on a 6-month basis for 2025, total imports are still about 14.5% lower than where they were during the same period in 2024. So you still have lower imports than what you had in 2024. And what needs to be seen is if imports are sustainable in the current high price environment. That would suggest a positive demand side influence, but the last 3 months of an uptick in imports may or may not be a suggestion of stronger ongoing demand. So one of the primary reasons given for increased Chinese imports was an increase in demand from Chinese jewelry fabricators. And while the deep discount of platinum to gold prices is supportive of platinum jewelry demand, there are several other factors that work against platinum jewelry demand. For one, it's not a perfect substitute for gold, which is known for holding its value better than platinum. And it's also not aesthetically comparable. So one metal is yellow, the other is white. So it's not necessary that someone who's looking to buy gold jewelry is going to switch over to making a platinum jewelry purchase. Platinum jewelry is also harder to fabricate, so it tends to cost more to fabricate. And that does take away a little bit of that discount that you have in platinum prices to gold prices. But finally, and most importantly, why Chinese consumer demand for platinum jewelry may not be strong is because the Chinese economy has a lot of domestic as well as international headwinds, which could weigh on economic growth, especially during the second half of this year, and is likely to reduce discretionary spending on things like jewelry, whether it's platinum or otherwise. When you have the auto sector in China, which is unlikely to be the reason for any increase in demand from platinum or any aggressive or sustained increase, because a lot of Chinese new vehicle sales are battery electric vehicles, which do not use auto catalysts. So it's unlikely that demand is coming from the auto sector. So we don't know for sure, but unless this level of demand is sustained over several months, this recent jump that may be seen in Chinese imports may just be a matter of restocking, and most of it being done at prices which are much lower than where they are today. So with that, let's move on to total platinum supply. Total platinum supply declined, which is made up of a mine supply and scrap supply, declined around 2% in 2024. It slipped to 6.7 million ounces, which was down from 6.8 million ounces in 2023. Both mine supply and scrap supply declined last year. Platinum mine supply has been declining now since 2006, and while a lot of that decline has to do with South Africa, mine supply has been declining from other mining regions as well, with the exception being Zimbabwe, where you've been seeing an increase in PGM mine supply. Last year, platinum mine supply declined about 2.3% and was at 5.5 million ounces. Platinum scrap supply declined by around 1% to 1.13 million ounces last year. And it was dragged down. So you had a decline in platinum scrap supply last year, in large part because of a weak commercial vehicle market, and also some long-standing issues that the scrap industry has been facing with regards to the removal of platinum from gasoline auto catalysts, the reduced market share of diesel passenger vehicles. So these trends, which have been in place for some time now, have resulted in the amount of platinum coming back from scrap auto catalysts been on the decline. So this is something that we think will continue to act as a headwind to platinum scrap supply, at least in the near to medium term. We expect total platinum supply to be slightly lower in 2025, slipping to about 6.6 million ounces, which would be a decline of 0.6% from 2024 levels. So what you're looking at here is the PGM basket price. And while there have been various operational reasons for PGM output mine supply to be declining over the past several years, one of the main factors weighing on global PGM mine supply in recent years is the weakening in the PGM basket price. So this chart is showing the average PGM basket price for mining companies in South Africa and North America. And these prices peaked in 2021 and have been declining since. Now, both the basket prices for both regions in 2024 were around the 2018-2019 level and were still higher than where they have been in most periods prior to that. That said, these are nominal prices. So in inflation adjusted terms, these basket prices would be lower still than what they were in 2018, 2019. And so we think that this would continue to act as a headwind and push mine supply in both these regions lower in the coming years. So this is South African capital expenditure in the mining sector. And after years of underinvestment between 2013 and 2020, there was an uptick in capital expenditure in South Africa between 2021 and 2023. Now, most of that investment was made in brownfield projects to replace aging mines and shafts. Much of that spending is now, in our opinion, behind us. And especially with the weakening prices, we think that that's something that will show up as a decline in coming years. It is worth noting, though, that while CapEx rose between 2021 and 2023, 2024, in nominal dollar terms, that was still just at levels that we had in around the 2009, 2012 level. So we did not see an increase more than what was seen back in 2009, 2012, and that's in nominal terms. So even though it may seem that there was an increase in the past few years, it's not been a substantial increase in the amount of capital expenditure in the mining industry. Again, something that we think will act as a headwind to mine supply in future years. So global PGM mining cash costs declined in 2024, and this was the first decline in cash costs in 5 years. That said, at around $900 an ounce, this was still the third highest level of cash costs on record. Cash costs declined last year for a variety of reasons. First, you had the weaker PGM prices. You had a strong dollar compared to producing country currencies. You had a general decline in inflation relative to what we'd seen in a couple of the years prior to last year. And you had mining companies restructuring operations to lower costs by either mining higher grade ore or reducing workforce in some cases. So all of these factors essentially came together and helped to bring down cash costs during 2024. So with that, let's look at platinum fabrication demand, which stood at about 6.5 million ounces in 2024, which was a decline of 0.3% from 2023. Demand last year was primarily supported by jewelry and electronics demand, with the auto sector acting as the main drag on platinum demand last year. So you had healthy economic conditions in the US and India, which helped to boost platinum jewelry demand in these two markets. You also have aggressive marketing of platinum jewelry in India, which gave an additional boost to Indian platinum jewelry demand. And after declining for a few years, last year you saw some stabilization in Chinese platinum jewelry demand. So all of this together helped platinum jewelry demand in 2024, which helped to reduce or offset some of that weakness in platinum auto demand in 2024. All of the markets mentioned before, the US, India, China, all of these are expected to see some growth in platinum jewelry demand this year as well, but potentially slower economic growth in the second half of 2025 could act as a headwind, primarily because weaker economic growth is going to reduce discretionary spending, and jewelry is probably going to be one of the first items to be moved away from. Electronics demand has been growing. It's been supported to a large extent by the AI sector. However, in the case of platinum, competition to hard disk drives from solid state drives, which do not use platinum, is expected to act as a headwind to platinum electronics demand in the coming years. So we expect to continue seeing a softness in platinum fabrication demand in 2025, with demand slipping about 0.2% from where it was in 2023. The auto sector is a major influence on platinum fabrication demand, and within the auto sector, commercial vehicles play an important role. So last year, commercial vehicle demand declined across major markets. During the first half of 2025, it's been a bit of a mixed bag, with some markets showing weak strength and others showing declines. If economic conditions continue to soften during the second half of 2025, or there is expectation of weaker economic growth in 2026, then this could weigh on commercial vehicle demand in the second half of 2025 and consequently pull down platinum fabrication demand. This chart shows us diesel passenger vehicle market share. Two largest markets here are Europe and India, and in both cases, the market share has been declining now for several years. In the case of Europe now, that market share is at record low levels. In the case of India, it's stabilized around 17%, but we think that there might be a reduction in market share in India as well because of higher taxes on some of these vehicles. So this is important for platinum fabrication demand, primarily because diesel vehicles use platinum-intensive catalysts. One of the most positive developments for the PGM markets was the reduction in BEV market share in Europe. BEVs do not use auto catalysts. And while diesel and gasoline engine market share continues to decline in Europe, these vehicles, the BEVs, have been replaced. The gasoline and diesel vehicles are being replaced by hybrids, which, with regards of as it pertains to PGMs, is similar to an internal combustion engine. So this shows the global market share of electric vehicles and plug-in hybrid electric vehicles. Global BEV sales grew last year, and so did global BEV market share. But the rate of growth slowed compared to what it was in the preceding years. And in large part, that weakness that we saw, or relative slowdown in growth that we saw, was because of a slowdown in Western markets. As the previous slide showed, there was a reduction in BEV market share in Europe. The US grew, but it grew relatively slowly. And most of that growth that we saw in BEV market share on a global basis last year had to do with strong growth in China. Hybrid sales also rose, and their market share also rose strongly in 2024, which is a positive for PGM demand because these vehicles are used with, or are rather fitted with, auto catalysts. And these trends that we saw last year, we think will continue during 2025. So we expect a continued growth in BEV market share, but a continued slowdown in that growth, and a stronger growth in hybrids. So net, this would be a positive for PGM demand. So with that, let's move on to palladium. Palladium prices essentially moved sideways during 2024 and much of the first half of 2025 as well. Palladium prices rose strongly alongside platinum towards the end of May. But the gains that we saw in platinum prices, where you had platinum prices rising back all the way to 2014 levels, the gains were not that strong in the case of palladium, where prices only were back to roughly around 2023 levels. So while not in a deficit, the palladium market has tightened significantly over the past couple of years. And yet, despite this, prices of palladium have been relatively weak. So while the tightening in the market has helped provide a floor to palladium prices, it's not helped palladium prices rise strongly because, like platinum, there is a large amount of above-ground palladium inventories. At the end of 2024, above-ground palladium inventories stood at a record 26.3 million ounces, which is roughly around 3 years of total annual supply or fabrication demand. Total palladium supply last year on a global basis, including mine supply and scrap supply, stood at 9.2 million ounces, which was a decline of 0.4% from 2023. The weakness in total supply was entirely driven by weakness in mine supply, with scrap supply actually rising during the year. So the weaker PGM prices, which is one of the primary factors driving down palladium mine supply, has many of these mining companies putting their mines either on care and maintenance or focusing on ore, which is lower palladium content, which is really quite the opposite of what we were seeing in the past few years, when mining companies were focusing their efforts more on developing as well as mining palladium-rich ore. We expect palladium mine supply to continue declining in 2025, which we think will weigh on total palladium supply during 2025 as well. Scrap supply, on the other hand, rose during 2024. Scrap supply rose during 2024, which was helped by a healthy passenger vehicle market last year and China's trade-in policy, which helped to bring in auto catalysts which were rich in palladium. This year, we think passenger vehicle sales will soften a little bit, primarily due to that expected potential weakness in the second half of this year, which could result in consumers keeping cars for longer, hence reducing the amount of catalysts available for scrapping. So there is an expectation of a slight reduction in scrap supply this year. Palladium fabrication demand was at 9.2 million ounces in 2024, which was a decline of about 0.4% from 2023. While palladium fab demand was down only slightly during 2024, it's a lot lower than where it was prior to COVID. And much of that weakness is tied to the auto sector. So there were two factors that have weighed heavily on palladium fabrication demand from the auto sector since COVID. The first was a sharp increase in BEV sales post-COVID. And the second is the reintroduction of platinum in gasoline auto catalysts, which took away some of palladium's market share in the gasoline auto catalyst composition. So both these factors we expect will continue to create headwinds for palladium fabrication demand. And this year, because of that slowing global economic growth, coupled with lower US passenger vehicle sales, we think that palladium fabrication demand would decline in 2025, slipping to about 9.08 million ounces, which, if that level of demand materializes, it would be a 1.3% decline from 2024 levels. So global passenger light-duty vehicle sales reached record high levels last year. And despite this, palladium fabrication demand from the auto sector softened. And that's primarily because a vast majority of these gains that we saw last year came from China. And in China, about a quarter of the sales were of battery electric vehicles, which do not use auto catalysts. And a large portion of the balance sales that happened in China were of small vehicles. So neither of these factors was particularly supportive of palladium fabrication demand, with, as I said, BEVs not requiring auto catalysts, and smaller vehicles in general require lower amounts of PGMs. This year, we expect global passenger light-duty vehicle sales to decline, which, coupled with last year's trends in the Chinese market, we think those trends would continue. So that, coupled with an overall decline in global passenger light-duty vehicle sales, should or is likely to create that major downdraft or decline on the auto sector side of palladium fabrication demand. So the US passenger vehicle market was supportive of palladium fabrication demand last year. Two things. One was an increase in auto sales last year, but also another factor that helped palladium fabrication demand from the US market was an increase in light-duty trucks. So these larger vehicles typically require more PGMs. And so it's as a result of that, that's helpful to palladium fabrication demand. As of last year, about 80% of the passenger light-duty vehicles sold in the US were light trucks. So it contributes to a large portion of US passenger vehicle sales. And this year, even though we do expect US passenger light-duty vehicle sales to decline, this trend of selling larger vehicles or light trucks is expected to remain supportive of palladium fabrication demand. Moving on to rhodium. The rhodium price mostly moved sideways with an upward bias during 2024. In 2025, we saw rhodium prices move higher alongside other PGMs, but the gains were relatively muted. The rhodium market surplus has shrunk over the past 2 years, though it is expected to rise this year on account of weaker fabrication demand. So global rhodium fabrication demand fell to 952,000 ounces in 2024, which was a decline of around 1% from 2023. Demand is projected to continue declining in 2025, slipping to 936,000 ounces or 1.6% from 2024 levels. This weakness is on combination of weaker auto sales and thrifting to the bare minimum in most cases, in most uses, which, coupled with an overall decline in demand for a variety of those fabricated products, is expected to weigh on rhodium fabrication demand. The rhodium supply declined last year to 964,000 ounces, which was a decline of 1.4% from 2023. And this year, total rhodium supply is expected to remain flat. The lack of growth in rhodium supply, coupled with various risks to South African mining, is expected to keep rhodium prices supported despite that somewhat weaker rhodium fabrication demand that is expected. So with that, I'll pass this back to Jeff to speak about the minor PGMs.
Thank you, Rohit. Thank you very much. those are the major markets. I will talk a little bit about the other three PGMs, which we've always had a special place in our hearts for, ruthenium, iridium, and osmium. The ruthenium price on an annual average basis last year declined about 7.6% from $401 on average in 2023 to about $371. But if you look at the price over the course of last year, it was lower at the beginning and it rose in the final 4 months of the year. So the price of ruthenium started last year around $370, close to the annual average, and it stayed low for a while there, but then rose to about $437 by the end of the year. And then since the beginning of this year, the ruthenium price has risen even further. It started the year around, $440 an ounce, but it got as high as $605 on a spike in March. And on the first half basis, the ruthenium price averaged $551 in the first half of this year. That was up 58% from the first half of last year. So what you were seeing with the ruthenium market, ruthenium is used in a host of applications. It's used along with platinum in hard disk drives. It's used in a host of chemical process catalysts that are used to make basic feedstocks for various types of plastics, as well as other chemicals that are used in a number of applications around the world. And what we saw was very weak demand and some destocking in the first half of last year, in the first 3 quarters of last year, 2/3 of last year, the first 8 months of last year. And that kept the price down. But hard drive demand has been skyrocketing because they're used in AI factories, shops. And so starting in the last 4 months of last year and continuing through the first half of this year, you saw a sharp increase in demand for ruthenium, partly from the hard drive sector of the market, but also from other chemical process catalysts and such. You have to remember that at the beginning of 2024, there were a lot of people who thought that we were probably headed into a recession last year, and a lot of companies had sort of pulled back from holding excess inventories of material then. And as the final 4 months of the year occurred, especially in September and October, you saw a surge in inventory building by industrial users, not just of ruthenium, but across things. And you may recall that base metals, energy metals, and other precious metals all rose very sharply into 28, 29 October, and then they came back off. So that's what we've been seeing in ruthenium. The basic demand for ruthenium from its industrial uses, its high-tech and chemical process uses, remains intact. Obviously, the AI industry has been growing very sharply. If it continues to grow as sharply as its promoters say, it will likely continue to require more ruthenium. If it implodes, which some people think is a potential, given some structural issues within that market, then you could see lower demand. And the chemical process industry is obviously very tied to the economic environment that we're looking at. Iridium prices rose sharply over the past decade, as we all know, and on an annual average basis last year, they rose. They were up about 2.6% to an average of $4,575 last year, up from about $4,460 in 2023. But if you look at it on an intraday basis, the price actually fell 15% over the course of last year. Fabrication demand for iridium. Iridium's used in a host of applications, everything from glass making to crystal growing and the equipment that's used to make a variety of high-tech electronic components, as well as a lot of high-tech electronic components themselves. The demand has been relatively strong for those basic uses. Again, we did see some inventory sellers, but what we have seen with iridium is that there was a lot of marketing discussion over the last several years about how platinum iridium electrodes could find a major use in hydrolyzing water to get green hydrogen for use in fuel cells. And you saw a lot of promotional discussion about how the world was going to need a lot of platinum and iridium for these hydrolyzing factories. If you looked at CPM Group's data, or if you looked at the International Energy Agency, we were both issuing notes of caution. First off, the fuel cell industry, fuel cells have stationary applications, and they have applications in off-road fleets, forklifts, or the vehicles that drive on the tarmac of airports. Places where you can have a fleet manager deal with the hydrogen and the refueling issues. Fuel cell vehicles have not done well as on-road powering, on-road vehicles, and probably will not. And if you look at the IEA's projections for fuel cell vehicles, it's very small as an on-road thing. If you look at the IEA's projections for hydrolyzing hydrogen to create hydrogen for a hydrogen economy, they have also been very cautious, because while you were seeing PGM fabricators build the capacity to make platinum iridium electrodes, you were not seeing much by way of investing in actual factories to hydrolyze water into hydrogen. And the IEA said, really for the next quarter century at least, this is probably not going to be a major industry. You're just not seeing the capital investments in that actual part of it. And it doesn't necessarily make economic and technical sense to use platinum iridium. Now, the discussion of using platinum and iridium led fabricators to build inventories, working inventories, and it led trading companies to build working inventories, and it led investors and speculators to buy inventories. Over the course of 2024, the attitude and belief that fuel cell vehicles and hydrolyzers using platinum iridium electrodes were going to be major uses of iridium sort of dissipated. And so you saw investors and speculators and fabricators and traders selling off their inventories or their investment holdings. And that inventory liquidation was behind the lower prices for iridium last year, right? So it had a relatively healthy market in terms of industrial demand from established industries, but the inventory liquidation did cause the price to fall. And the price fell even faster in the first half of this year. The price of iridium fell from about 16% from around $4,100 at the start of this year to $4,025 by the end of June. And they actually got as low as $3,825 in late May. So that lower price doesn't reflect weaker fabrication demand, it reflects inventory liquidation. And the last metal is osmium. And osmium prices have been basically unchanged between $350 and $400 since the late 1980s. There are relatively small, stable uses for osmium. There have not been a lot of new uses that have come along. There seems to be plenty of metal in refined and unrefined or semi-refined. You'll have tank house slimes that have the osmium in it still that has not been refined to refined osmium levels for a variety of reasons that I won't bore you with. But it's there and it's available should there be demand. There were some people in Europe who were hawking what they considered high-tech osmium at prices that were far over, $5,000 an ounce, not $400 an ounce. They seem to have sort of gone away. Maybe they haven't. Maybe I'm just fortunate and I haven't, heard about them lately. But the osmium market itself has been stable at $400 an ounce for most of my career, and probably will continue to stay stable. That's all we have in terms of our presentation. Again, you can order the PGM yearbook and download it later today at our website. We also have silver and gold yearbooks that are available immediately to be downloaded as ebooks. And at that point, I'm going to ask Rohit and Carlos to join me, and we'll get into the question and answer period. So, Carlos, you're going to be in charge of questions. Take the lead.
Yes. Great, Jeff. Thank you, Jeff, Rohit, for the presentation. So we had more than 70, 60 questions come in, and many were answered during the presentation, but there are a few that we'll be asking. And as Jeff mentioned, if you have any questions, please write them into the question pane in this webinar, and we'll try to respond here. So the first question is, Jeff, Rohit, can you compare investment demand versus industrial demand in terms of volume, timing, and seasonality?
You want to take that, Rohit, or shall I?
I can try to answer that. I'm not sure if I understood that question completely, though. Is the question asking how fabrication compares to investment?
Yeah. You want me to take it?
Yeah, sure.
Yeah. Investment demand, the vast majority of Platinum Group Metals goes into fabricated products. It's industrial demand. Automotive, as what Rod explained, it's not just automotive, but there's a variety of other things. There are a few 100,000 ounces of platinum that are bought by investors annually. And there is probably even smaller volumes of palladium. We have seen in times in the past, for example, in 2000, 2001, 2002, CPM Group issued a long-term buy recommendation for platinum. And we had a number of wealthy clients and hedge fund clients and others who bought a tremendous amount of platinum between, say, 2002 and 2008. And by tremendous amount, Rohit showed you a chart of the inventories, and that chart's in the yearbook. You saw a steady increase in above ground inventories in that period of time. And that a lot of those inventories actually went into investor holdings. Some of those inventories were sold 2012, 2013, the first half of 2014. As Rohit explained, once the price fell below 1,400 in the middle of 2014, those investors that had been buying earlier in the century kind of pulled back from selling physical platinum. They said, we're going to hedge our remaining inventories, which are large, with NYMEX short positions, and we're going to wait to see where the platinum price goes. And some of those guys have been holding that platinum for 11 years, waiting for the price to get back over 1400. So it's a very interesting time right now. But in terms of the relative size of the platinum market, investment market relative to industrial, both for platinum and palladium, the vast majority of metal goes into fabricated products. In terms of seasonality, I don't think there's enough data on platinum and palladium investment demand to really talk about seasonal patterns. There are seasonal patterns in commodities investing in general, which probably lays over. So you tend to see investors go away on vacation in July and August. They sit at the beach. They think about how the first half of the year went. They come back in September and October, and they start revising their portfolios based on some of the stuff they read while they were on vacation and the thoughts they've had. So you tend to see some pickup in September, October, and then you tend to see some pickup in January and February based on sort of the same things, plus the fact that there is seasonal demand increases for fabrication demand that investors are aware of. Next question.
Okay, the following question. Do you believe the world needs to find new PGM deposits?
Bro?
Yeah, I would say no. There seems to be enough supply both from mining as well as above ground to meet fabrication demand. So I don't believe there's need for new deposits. There is replacement of some of the existing mines and shafts, especially in South Africa. And you are seeing a suspension or closure of various mines in North America. So with that happening, there's no need at the moment, unless there's some big pickup in PGM demand in the future, which we don't anticipate. There doesn't seem to be a reason to be looking for new deposits.
Yeah, I would just add, yeah, as Rohit said, there are enormous reserves and resources in South Africa, and there is an established mining industry there. It's probably not a matter of needing to find new mines, but rather to rationalize the mining operations to more cost effectively extract those metals. In terms of Russia, there's a lot of secrecy about the reserves and resources, but there was research done in the West by both during the Soviet era and in the post-Soviet period. And in the 1990s, I believe that the estimates were that there's probably 50 years worth of reserves and more than 100 years worth of resources within Russia, that probable resources. So there's plenty of metal there. And then in North America, you do have a number of properties. They tend to be lower grade, but there's some very interesting projects. I mentioned at the outset that one of our sponsors is in fact researching some of those properties, and Stillwater Critical Metals, and to give them a little advertising here. A lot of those properties have been known for decades and are maybe too low grade or too low tonnage. We do have, Rohit mentioned that one of the properties that was developed, the Lac de Ile mine, which was then later sold from North American Palladium to Impella, is headed toward being closed at this point. It operated for 3 decades or more. But the metal's there and the deposits are known. It's a matter of having them developed in a way that they can be profitably mined.
Okay. Next question. Do central banks or financial institutions buy and or store platinum as they do with gold?
Platinum is not a monetary asset by the way of central bank definitions, as is silver. Silver and platinum are not monetary assets. Central banks can hold as their reserves currencies, gold, special drawing rights, and reserve positions in the IMF. Those are the things that the central banking industry, the Bank for International Settlement, and the central banks and the IMF have agreed are monetary assets. So central banks will not do that. When you start talking about financial institutions, you have to, are you talking about buy side or sell side? If you're a bullion dealer or a bullion dealing bank, you may own some platinum that, as by virtue of being a market maker, you're buying and selling platinum. So when more people want to sell platinum than want to buy it, you wind up buying inventories and holding those inventories. You then lease that platinum out, if you can, to industrial users. And there is some metal that is held in that way by sell side institutions. In terms of financial institutions on the buy side, most institutional investors, the large pension funds, sovereign wealth funds, and others, do not necessarily own Platinum Group Metals. We have worked with hedge funds and private equity funds and others since the 1980s in buying and holding and selling at the right time Platinum Group Metals, including platinum, and primarily platinum. So that does actually happen, but it's relatively it's relatively non-public institutions that do that.
Okay. Next question is, how much of an impact does platinum jewelry demand have on the price of platinum?
I think both things work, and I think the jewelry demand obviously has a positive impact on platinum prices, but platinum prices probably have a stronger impact on jewelry demand. It's been seen that platinum or any jewelry demand tends to have typically a inverse relation with the price of the metal. So we've seen this with gold, silver, as well as platinum. There's obviously more than just the price that influences jewelry demand. There's also what's happening more broadly in the economic environment of whichever country you're thinking about, which would influence jewelry demand. But in terms of which one has more impact on the other, it's the price would have more of an impact on jewelry demand than jewelry demand itself on the price of platinum.
Okay. The next question is, can you talk a bit about the hoarding of auto catalysts?
Hoarding of auto catalysts?
Of spent auto catalysts.
Of spent auto catalysts, yeah. We're kind of reluctant to talk about that. The collection process of spent auto catalysts is a very interesting industry in terms of the way the metal gets from a car that's being deregistered to a refinery to make it. And it's an amalgam of a cash industry, the scrappers and collectors, and large corporations that have working inventories that can get tied up for months on end before you have refined out. You're buying substrate to smelt and refine, and it can take months before you have refined metal to sell. So you have a large financial exposure and commitment to your working inventories. On the cash end, the scrap collectors and scrap dealers are very savvy. And when they feel that the price is that they get for the spent catalyst is too low, they will just leave, they'll build up inventories. And that has, I think, probably been happening for several years now. It happens sporadically, and then the prices will rise and you'll see some metal come in. So with the higher prices of platinum and palladium and rhodium in June and July for platinum and palladium, and rhodium in March in the second quarter, you may start seeing some of that there. There's other hoarding that I don't think that we will just go into at this point.
Okay. The next question is, how much of an issue do the ongoing power failures in South Africa have on PGM mine production?
So it is one of the bigger risks that South African mining is facing. You do see disruptions to supply from time to time. Obviously, the mining companies are also trying to find alternative backups to provide electricity to their mines. So it is an ongoing issue. It's been an issue for many years, and it's a risk that helps to keep a floor for PGM prices because of the amount of PGM that comes out of South Africa.
Okay. The next question is, can you talk about the impact of the transition from ICE vehicles to EV vehicles on PGM prices?
So the EV vehicles, as long as if they're BEV vehicles, which is essentially cars that only run on batteries, that is the kind of vehicle that is negative for PGM demand because you don't have auto catalyst fitted to these cars. But if you're also referring to electric vehicles or rather referring to hybrids as electric vehicles, then those do not necessarily have a negative impact on PGM demand because they use auto catalysts, and the amount of PGM going into those auto catalysts is roughly the same amount as would go into ICE vehicles. So the transition to electric is obviously a headwind to PGMs, but it depends on how strong the demand for BEVs is going forward. So far it's been BEV sales or market share has grown quite a bit in the last few years. It was roughly around 2% prior to COVID, and then as of last year, on a global basis, BEVs account for around 13% of passenger light duty vehicles. So it's grown pretty substantially, but that growth rate has been slowing. So that is in fact less of a problem for PGMs and is actually a positive development for PGMs.
Okay, the next question. Do you believe that rhodium will be replaced or removed from auto catalysts at some point?
So there's already been a lot of thrifting of rhodium in auto catalysts. It's not likely to be completely removed. It is the only one that can be used for, among the PGMs that can be used for reducing nitrogen oxide emissions. And a lot of the recent emission standards, as well as the Euro 7 that is supposed to come into effect, is heavily focused on reducing these nitrogen oxide emissions. So rhodium is not likely to be removed from auto catalysts.
Okay, this question relates to Russia. Can you talk about the impact of Russian production of PGMs on the global market, given what's happening with the geopolitics, the politics of Ukraine, Russia conflict, sanctions, etc.
There hasn't been any direct negative impact. There have been concerns ever since the war started of disruptions in supply, but there hasn't actually been any disruption to supply out of Russia. You in fact have seen Russian PGM mine supply rise last year, and it's been holding up pretty well despite the conflict that is going on right now. They have been that the sanctions obviously are squeezing mining companies in Russia for finances, which would have long-term negative impacts. But in the past few years, as well as even this year, there's not expected to be any decline in PGM supply because of that conflict.
Okay. This relates to minor PGMs. Can you provide perhaps a longer term outlook for iridium, rhodium, and ruthenium?
Well, in terms of iridium and ruthenium, we do have, we have 10-year projections for supply, demand, and price for iridium and ruthenium. And we have platinum, palladium, rhodium projections going out 25 years at this point to 2050. So we do have these views that are part of our research behind the paywall. What I will say is that if I look at iridium and ruthenium, they have a number of critical uses in a variety of industries. They seem to have been running off of long built up inventories that were built up over decades when people were mining to get at the platinum or their nickel or their palladium, and these byproducts were coming out in volumes that industry did not want. And I think that iridium and ruthenium have been living off those inventories for a long time, and that puts them at risk to seeing tighter supplies and higher prices, which is in fact what we've seen over the last 15 years in ruthenium and in iridium. In terms of rhodium, it's going to depend heavily on the auto industry, and maybe I kick it over to Rohit to let him talk about what we see in some obtuse fashion about the outlook for rhodium prices.
So, I mean, for rhodium, I think we are seeing a tightening market in rhodium. And as I mentioned previously, the new emission standards that are coming into effect, those would be focusing a lot on reducing these nitrogen oxide emissions. So demand for rhodium, which about 80% of fabrication demand for rhodium is in auto catalysts. So at least in the medium term, we see rhodium prices moving sideways to probably a little bit higher, but not necessarily the kind of spike we saw unless there's a major supply disruption. It's unlikely to see the kind of spike that we saw in prices a few years ago.
I would add in terms of rhodium, because I started in this business before rhodium was used in auto catalysts. And there were a number of industrial uses and decorative uses for rhodium that when the auto industry started using large volumes of rhodium, it basically squeezed out a lot of other uses. Rhodium's a very versatile metal. It has a number of valuable properties, chemical, electronic, and other plating applications, catalytic applications in chemical processing and petroleum product refining. So, yeah, as Roy was saying, the auto industry has come to the point where it takes 80% of the world's rhodium, and it has squeezed out rhodium use in a number of other applications. As the auto industry moves away from using PGMs as intensely as it has, if not entirely, over the next half century, uh, the rhodium price may become, and the rhodium availability may become sufficiently lower for price and higher for inventories that you'll start seeing rhodium used in a lot of applications, either old applications coming back to it or new applications that are developed now that rhodium is perhaps more cost effective and competitive with other materials. When you're a company and you're looking at a new product, and your research and development people are developing a product, and you say, well, it uses rhodium or ruthenium or iridium or some other metals that are not noble metals, but like indium or scandium. Scandium is a metal that CPM Group's doing some research on again. It's a metal that if you ever had sufficient supplies, there'd be a tremendous demand for scandium. But given that there is insufficient scandium supplies readily available at current market conditions and prices, the aluminum industry and other industries that would use it don't use it. And the same is true for rhodium, iridium, ruthenium, and even to some extent platinum and palladium. So if you see the auto industry transitioning away from using as much these metals, you'll see increased uses. But the companies that develop new products say, okay, I've got this widget, or I'm going to build a factory to make chlorine, and I can use this technology that uses rhodium as a catalyst, and I can use this technology that doesn't use rhodium. And if you go back 50 years ago, before the auto industry got into the rhodium market, they would maybe pick the rhodium technology because it was a low-priced metal and with ample supplies. 20 years ago, 30 years ago, we were leasing rhodium and actually structuring synthetic options for rhodium for companies that needed rhodium in their factories, but the price was so high, they said, let us lease the metal or let's buy options to protect ourselves from it at this point. Going forward, and I'm not sure where we are in terms of price sensitivity, but at $5,000 an ounce, you might be there again. A company looking at a chlorine factory might say, okay, let's use the rhodium catalyst technology instead of the alternative technology. But each manufacturer has to decide, does it want to have exposure to these relatively small, esoteric, non-exchange traded, secretive metals? I mean, we've seen over the years, starting in the 80s, we've seen companies come to us and buy research on ruthenium and iridium and rhodium and indium and other metals and say, well, we've got a new use that might use these metals. And then they decide not to use them because they don't think there's sufficient supply or would be sufficient supply to meet their demand.
Okay, here we have the last question, the last few questions. Many have asked about the 1-year outlook for PGMs, platinum, palladium, rhodium, but they've also asked about the 3 to 5 year outlook for PGMs. What is our outlook for platinum, palladium, or I guess the 3 to 5 year? And also, do we believe that palladium will outperform Platinum.
You want to take that one, Rohit? Or
Um, so I mean, our outlook for the PGMs in the short term is going to be dependent on what happens with fabrication demand, and if we are seeing a true uptick in fabrication demand. We don't think that increase that is being expected currently in the market is likely to materialize. As Jeff mentioned, economic outlook for the second half of this year as well as into 2026 is not for strong economic growth. So you're probably going to see a fair amount of headwinds from the fabrication demand side, which should limit the upside for PGMs. But also, given that these PGM markets have become a lot tighter now than they were 2 or 3 years ago, they are likely to be very vulnerable to any kind of supply side shock. And there are a lot of supply side risks, whether it be from South Africa, you have safety related issues, you have electricity issues, or if it's, mines being put on care and maintenance or being shut down. There's a lot of different risks coming in from the supply side as well. So most likely you see prices in the near term moving, sideways with slightly lower than where they are right now, but not, breaking below the lows that we have been at, or the ranges that we've been at in the past few years. So slightly higher ranges, at least till there's, more clarity with regards to how fabrication demand develops over the next few quarters.
I'll just add one little thing, which Rohit told me yesterday, is if you look at some of the data that's available publicly, and there's very little data on investment demand that's publicly available, but one of the things that you have are ETF holdings. And one of the things that we have seen, we've been saying for 11 years, we have to wait until the price gets back to 1,400 to see what inventory holders are going to do. If they think that that is a recovery and the price is going to rise further, they won't sell their metal at 1,400. They might even buy more. If they think that the price will fall back lower, they might sell. And we've only had a few weeks over 1,400, but we have seen profit taking on the part of ETF holders, more so than people saying, okay, the price has risen 50% in the last 5 weeks. I think it's going to rise another 50%. So I'm going to buy. So I think that, obviously the industrial demand, because it's so large, is going to be very important to the price. But you also have the whole question of what are investors going to do? Is that the last question, Carlos?
Yes, there are no more questions. There are a few that I think we've covered throughout the presentation, but that's it for the questions for now.
Well, we run almost 90 minutes. I hope this has been helpful and informative to the attendees. I want to thank the attendees who are still here. There are a fair number that have stuck around throughout the entire time. This is the end of our 2025 yearbook cycle. We are always here, and we're producing other research that we sell as subscriptions. If you are interested in CPM Group, you can go to our cpmgroup.com and see what all of the services are that we provide. And we will be around. We'll continue to be doing our twice weekly videos, more or less twice weekly videos going forward to have a little bit of a public exposure. But we're around, and let us know if we can help you. And thank you for being here today.